Welcome to Explain the Charts, your source for detailed market analysis and actionable price action insights. Today is March 23, 2026, and we are breaking down the EURUSD pair after a week of significant volatility. The current market sentiment is being heavily influenced by central bank activity and evolving economic indicators. Headlines suggest that the US dollar and precious metals are slumping as the Federal Reserve and ECB prepare to pivot their monetary policies. BCA research has warned that sticky inflation remains a major concern, causing them to downgrade stocks to underweight. While the dollar index has attempted to edge higher after previous falls, the euro remains in a fragile balance. Geopolitical tensions in the Middle East, particularly involving Iran, have heightened market uncertainty and impacted energy costs. ING reports that although energy prices are unlikely to revisit 2022 extremes, downside risks for the euro still exist. Commerzbank notes that safe haven demand has pushed EURUSD below the 1.1500 mark recently, though a recovery is underway. Now, let's transition into the data to see how these fundamental drivers are manifesting on the price charts. Looking at the daily chart for the first quarter of 2026, we see a very distinct market structure. The pair reached a significant multi-month high of 1.2018 on January 27th, which served as a massive rejection point. From that peak, a sustained bearish trend emerged throughout February, driving prices toward the 1.1500 level. We can see that the price found a very strong support floor near 1.1450, which acted as a multi-year pivot point. On March 13th, the pair dipped as low as 1.1415 before bulls stepped in to defend this critical zone. This rebound confirms that there is significant buying interest at these lower valuations despite the overarching bearish sentiment. The daily candles for late March show a gradual recovery, with price attempting to stabilize around 1.1560. However, the struggle remains evident as price struggles to build momentum above the 1.1600 psychological resistance. Sellers still maintain control on this timeframe as long as we stay below the high of the March 19th candle. The correlation between the safe haven demand and the 1.1450 support test is undeniable given the geopolitical news flow. Zooming into the 1-hour chart, we can analyze the micro-reversals that occurred over the last 2 weeks. Between March 11th and March 13th, we witnessed a sharp decline from 1.1611 to 1.1415, reflecting a strong US dollar rebound. Following that bottom, a 2-day recovery move pushed the pair back toward the 1.1550 level. Price action flatlined below the 200-hour simple moving average, which acted as a dynamic resistance point during this period. On March 18th, there was a notable test of 1.1448 during the European session before a violent surge upward. This surge pushed the euro as high as 1.1616 on March 19th, briefly breaking the previous resistance. This move appeared to be a liquidity grab or a short squeeze, as price was unable to sustain those levels. We then saw a retracement to 1.1560, where the pair has consolidated for the past few trading sessions. The hourly candles indicate that the 1.1530 area is now serving as short-term support. Volatility remains high, and traders should be cautious of false breakouts around the 1.1600 level. The inability to close hourly candles above 1.1600 suggests that sellers are defending this zone aggressively. Watch the 1-hour 50-period moving average for signs of a trend shift if price begins to hold above it. Let's look at the 15-minute time frame to understand the most recent intraday price action leading into today. During the late session on March 20th, the price saw a steady drift from 1.1574 down to 1.1555. By Sunday evening, March 22nd, liquidity began to return, and the price ticked higher to reach 1.1561. The 15-minute chart shows a very tight consolidation range between 1.1535 and 1.1565. This range suggests that institutional traders are positioning themselves ahead of the next central bank announcement. Volume has been relatively low, but we see spikes whenever the price approaches the 1.1540 support level. The intraday trend is currently neutral, with no clear bias until we break out of this 30-pip range. Traders should look for a 15-minute close above 1.1570 to confirm a bullish intraday bias. Conversely, a break below 1.1530 would likely signal a retest of the 1.1500 psychological floor. The tight candles we see here are indicative of a market waiting for a high-impact news catalyst. Recapping the important price levels, your major support is at 1.1450 and short-term support is at 1.1535. The critical resistance levels to watch are 1.1600 and the recent peak of 1.1616. I provide an unbiased prediction that there is a 60% likelihood of a bullish breakout toward 1.1700. This bullish scenario would be reinforced if the Federal Reserve signals a more dovish stance in upcoming meetings. There is a 40% probability that we retest the 1.1400 support if geopolitical tensions escalate further. Escalating conflict usually drives safe haven flows into the US dollar, which would be bearish for this pair. Keep an eye on the energy sector and oil prices as they continue to influence European inflation data. Long term, the 1.2000 level remains the ultimate target for bulls, but it requires a clear breach of 1.1700 first. Always wait for price confirmation at these levels before entering a trade to avoid being caught in a trap. Monitor the economic calendar for any surprise interest rate hike talk from the ECB, as that could trigger a 1% surge. This concludes our in-depth analysis of the EURUSD pair on Explain the Charts. Please remember that this is not financial advice, and you should always do your own research before investing. Trading foreign exchange carries significant risk, and you should only trade with capital you can afford to lose. Thank you for watching, and we will see you in the next chart breakdown.